Hello, everybody, and welcome to the Storebrand Global ESG Plus webinar. My name is Spiros Allen, and I am responsible for international investors at Storebrand Asset Management, and I will be your host today. The Global ESG Plus strategy is an index tracking climate-aware strategy. It excludes fossil fuel-related and climate-negative companies. It invests in climate solutions, and it is managed with additional ESG criteria. The PM who is with us today is Henrik Wold Nilsen, and he has been at Storebrand since 2010. He is the lead PM for the strategy, which has 3 funds, and total assets under management for these 3 funds is $4 billion, or approximately 3.3 billion euros. We will have questions at the end of the session, so please feel free to send questions during the presentation. This presentation will also be recorded, and the recording will be sent to you by your Storebrand or Skagen advisors. So Henrik, I leave the floor to you.
Thanks a lot. So I hope I'm unmuted now. Alan, please nod if that is correct. Good stuff. Yeah, so this is our first webinar of this sort, and we intend to have this on a quarterly basis going forward. And since this is the very first one, I summarize not only the previous quarter, but the full last year. And it's split into 2 sections. First is a run through of what happened last year in terms of performance and attribution. And then for the second part, which is also really important, is I'll illustrate how we for this fund continuously work to improve the strategy as we learn more and as we gain access to better data, because climate change is a rapidly moving target. Last year was an extreme stress test for many parts of society, and also, not most importantly, but also for our risk management process. If you look on the left-hand side, there is a graph showing the absolute risk or the volatility of the return time series of the benchmark MSCI World Index in orange and the fund in blue. And you can't really see the blue one very much because they're on top of each other. And I mean, that's a natural consequence of our fund being quite close to the benchmark in terms of return and risk properties. But the main point here, of course, is the huge jump upwards from a steady, stable, low level in the preceding years. And then it makes rises by 4 times over. Rapidly, just about 1 year ago, of course, triggered by the COVID crisis. This any strategy that you had, which had a certain expected tracking error level up front, will have realized tracking levels a lot higher because everything moves all over the place during this period. And on the right-hand side, you can see then the relative risk of the fund, the tracking error versus MSCI World. And it has been around 1% for since launch, which is where also the risk model sets the expected tracking error is. And then it jumped up by a factor of 2. This is, by the way, with a 90-day time window, so quite responsive, quite short time horizon. And then it's fallen down again more to where it used to be afterwards. And our fund is minimizing the tracking error property subject to having the climate profile we seek. So this was a really interesting test for how well does our risk management process work in real life under such extreme conditions. And the answer you can find on the next slide, and it's related to what happened to the return of the fund compared to the benchmark return. Let me first make some general comments. On the left-hand side, there you see the total return, the absolute return of the benchmark and the portfolio. And no, they are not on top of each anymore. So you see both colors, blue for benchmark, green for fund. And of course, as you move from the left, you see that the market was perfectly happy, even though there were some news about something going on in Wuhan. And then the market fell off a cliff. And then afterwards recovering quite nicely against what you would maybe believe. So markets are on all-time high again. This is, by the way, in euro. You can find in British pounds in the appendix. On the right-hand side is the difference between the two, by the way, gross of fee. And you can see then the year started quite positively, and then enters the more wobbly part, which is this massive drop. The good part for me as fund manager and responsible for the risk management process is that those months around the COVID crash, if you would just look on the right-hand side, you wouldn't notice that something spectacular had happened there. I mean, it's a bit more wobbly than normally, but that's not what grabs attention on this graph, rather the fact that it's rising steadily throughout the year. And that reflects that last year was a really positive year for the strategy. And that came on top of also good returns previously during the fund existence, and it brings them the since inception relative return to 1.8% annualized. Some reflections on why this was a good year for the strategy. And there are two main drivers that I bring to your attention. One is the implications of lockdown. On the left-hand side is global oil consumption rising steadily as it has done for many, many years, year over year. This is the last 5 years, what you see there. And then came last year and it fell off a cliff. People stayed at home and did not travel anymore. And of course, then the $1 million of barrel of oil per day fell from above 100 down to 80 at the bottom. It has recovered quite a bit since then. And this you can see also the implication of on the chart on the right, which is the oil price, which fell dramatically in the beginning of 2020, but has recovered quite a lot since then. For our fund, which is fossil-free, not owning oil production companies, this was a good thing, actually. This consequence of COVID helped our performance because it drew down the stock price of oil and gas producers, and we don't own them, so relative to benchmark, this leads to excess return. And the other side is what happened on the climate policy, climate mitigation agenda last year. It was actually a really positive year for climate development. You could maybe think that the COVID crisis would draw all attention to it away from climate, and that climate would be ignored. Let's deal with short-term problems, then we can deal with climate later on. Fortunately, that did not happen. And although the physical meetings for hiking up Paris ambitions didn't happen in Glasgow as planned, there was still a good process with many countries bringing new promises to the table for what they will do to achieve Paris Agreement. China, Japan and South Korea all announced new net zero targets within a few weeks of each other in autumn. The EU made a lot of development on both long-term targets, which were increased, and also on more short-term implications, policies, which put us on the right trajectory for achieving those long-term targets. And last but not least, the political development in the US means that we have the US back on board within the Paris Agreement as of yesterday. This is a major pickup also for our strategy, that we have the US on board, not just on a state-by-state level, but on the federal level. So all of this was very beneficial for the stock price of companies which provide solutions to the climate crisis. And as you probably know, our fund allocates 10% of the assets to such companies, giving them a good tailwind last year. So it's a long short trade for us. We are short oil, which went down, and we are long green alternatives, which went up. So we benefited from both of these developments. And this is the detailed attribution slide. It's messy, apologize for that. So please try to not look at everything simultaneously. Let's focus instead on the graph on the upper left. That shows for last year the quarterly attribution or contribution from each element or each ingredient in our strategy. So our strategy has several different streams, so list of companies we don't invest in. And first and foremost is the fossil fuel producers and the value chain. And the return implication of that, contribution to relative return, is in orange line. So you can see everything starts at 0 at the year beginning, and then 3 quarters in a row we saw a very good performance from not owning these companies before it flattened out over the last quarter. And that is the main contributor to the sum of all effects, so the total attribution for the fund in the dotted line. The second component contributing quite a lot last year was the green line. It stayed at 0 in the beginning, and that's the climate solutions portfolio. So we allocate 10% to companies within renewable energy, energy efficiency, low carbon transportation, recycling, access to clean water. And these are the companies that we see benefit the most from Paris Agreement implementation. So that's sort of the flip side of not owning fossil fuel producers. And over the last half of the year, in parallel with these positive political developments, investors also showed a lot of interest in this segment and renewed optimism for future prospects. This part of the portfolio then contributed 2 percentage points to the fund's total return. And that's quite good, coming from only 10% of the fund. So it's a 20% relative outperformance then for this segment of stocks, but 2% contribution to at the fund level. And the other screens and everything else that we own in the fund, the 90% which are not climate solutions, added up more or less to 0. So the net effect was screening fossil and owning climate solutions. And on the right-hand side, you can see the same chart, but from the launch of the first investment vehicle using this strategy, the Swedish domiciled one, launched April 2016. And then you can see for the first few years, the dotted line went nowhere, a bit down, a bit up, a bit down again. But for the last 2 years, there has been a solid trend in parallel with more optimism when it comes to climate mitigation in terms of political life, investor sphere, and also among consumers. And the main effect has been the fossil fuel screen, but with climate solutions picking up steam last year. And the same information you can see downstairs in the table, but we won't go through it in detail now. You can split also the climate solution into different sub-themes since launch here. On the left-hand side is renewable energy, by far the best, but most of them are positive. Recycling, water, energy efficiency, something called green chemistry, so chemistry based on biomass. And there is also now one called carbon capture and storage. There is one single pure play company within that in Norway, IPO'd last year. And green transport is the negative one, mainly due to COVID implications for operators of public transport. You can imagine those have had a hard time. So in sum then, it's almost equal to renewable energy with all else cancelling out. So much for performance. Now over to our continual process of improving on our strategy. So what we did last year was to continue the work we do all the time with having our radar turned on to try to identify pure play providers of climate solutions for this 10% allocation of the fund. We also adopted a new data set from FTSE Green Revenue, which measures the percent of sales for each company exposed to a long list of green thematics. So this enhances then the effect of the 10% pure play allocation by going a bit broader in themes and also going into companies which are not pure play, but more conglomerates. So it complements the pure play strategy. Then we added a new data set, which is a complement to carbon footprint data. Carbon footprint looks at what has happened last year, emissions compared to sales, but it doesn't tell you where the company is heading. And current emissions are a consequence of investment decisions, which might be a few years back. So also interesting is where a company heading, and then having a preference for those companies which are currently making good choices and which have plans in line with Paris. Then we added some new rules for how large overweights can we have per company, and that is about managing the trade-off between strategy tilts, how strong a climate flavor, so to say, can you have, while balancing that with liquidity and making sure that you don't buy any less liquid position which is not motivated by climate. Any illiquidity there is should be managed and well controlled and should be motivated by the main targets of the fund, climate. And last but not least, we read up on the EU Paris aligned benchmark framework. And we noticed that our fund is almost compatible with that already, because we share motivation and intention with them, but they have some very specific sets of rules about what you should do. And we have been looking at that, and we have adopted most of those rules just to make sure we are compliant with it, but it really had close to zero effect on our strategy since we were already well within those limits anyway. And this just illustrates how we continuously work to improve our strategy within the same mutual fund. And that's a contrast to a more index-based approach, where the asset manager buys an index from FTSE or MSCI or companies like that. And then it's a static construction. And as time goes along, it will become outdated. And then the asset owner needs to move their money into a new, more up-to-speed version, which is then state-of-the-art, maybe at launch, but which is then again static and becomes outdated. So our alternative is we prefer to own the whole construction process of the strategy, because then we're able to continuously improve on it. And then I think that's an advantage also for the asset owners to stay state-of-the-art within the same vehicle. So a bit more in detail then about each of these improvements. This is a long list of companies that we took into the climate solution portfolio last year, and they are mostly outside of MSCI World. And most of them are small cap. And that's a bit what we try to do with this part of the strategy, to give access to smaller pure play companies in the climate solutions space. And most of the interesting companies in this segment are too small as of today to be part of MSCI World. So then you need to open up investment universe to smaller companies selectively, thematically to this space. Last year, we also improved a bit on our trading strategy for these by taking more ownership to how it's been traded and spending more time. We're able to go a bit further down in market cap without increasing trading costs. So that's an improvement last year. It's a bit more work for us, but then we can gain access to a lot more of these smaller specialized companies. The first of them on the list, for instance, is a really interesting one, Aker Carbon Capture. It's the very first, to our knowledge, pure play company within carbon capture and storage. And that's a central technology to achieving climate targets according to research. And it was IPO'd last year as a spin-off from a Norwegian company. And we invested a little bit in it. It's small, so we couldn't allocate a lot to it, but it was 1%, no, 1% out of a percent, so 1 basis point, 0.01%, so almost nothing. So it's not important for the fund's profile to own these very small companies, but I really like to have a complete coverage in this space, and it adds up. When you have many of these small, then you gain access to a very interesting segment. And these are the ones which benefit the most from Paris Agreement. And in particular, this company has increased 4 times over since we bought it. So it's an example of a successful investment in this space. In total then, on the lower right, you can see that we now currently have 2.7% of the fund in this list of companies, which was added last year. So when you add up many of these small positions, then it becomes relevant in the end. And this is a really interesting part of my job as well, to monitor for these companies, read up on them, to certify that the products they have are stand to benefit massively from Paris Agreement implementation. But we don't do stock picking, so I don't try to pick the winners here. We like them all equally much, and the weights are then determined, one, by the market cap of the company, buying more of the larger companies, and 2, by the risk minimization process to diversify and reduce the risk of owning this. Here is an overview we have made of the different components in the fund strategy. And what is shown in this waterfall chart is the construction of the fund if you would pull it into pieces and then turn off one feature at a time. So this is just a toy example for illustration. On the far right is the final fund, everything together, 1% tracking error. And it's normally managed as a totality, not one piece added after another. So this is just for illustration. But if you start on the left, what I've done first is to take out fossil screened companies and then scaling up everything else proportionally. And that alone would give 1% tracking error. If you exclude also tobacco, gambling, weapons, alcohol, then you add another 0.4%. Then I take out a list of companies which are not per se fossil fuel producers, but which are also heavily climate negative and against the intention of the fund. 0.25% added in tracking error. And then finally conduct based. So that's broadly speaking UN Global Compact breaches against international norms and conventions, human rights, labor rights, corruption. So in totality, without risk management, you would gain and you would land at 1.7% tracking error. But when you turn on the risk minimization process to optimally shuffle around on what you actually do own to minimize the risk towards the full normal MSCI World, then you are able to reduce the tracking error by 1 percentage point, landing at 0.7%. And then we so to say reinvest a bit of the gain there into adding a more holistic view on climate. I've put a red circle around those components which are new as of last year. And the dotted one, the first, is weight constraints. We did some modifications there on how much are you allowed to be overweight each company. We already have such mechanisms in place, so that was a minor adjustment, so therefore dotted. Then we add climate solutions exposure, FTSE green revenue dataset, science-based targets, which I mentioned earlier. Sustainalytics has a carbon risk, climate risk model, which we use. Then we use carbon footprint. Sustainalytics also have a ESG model for everything but climate. We split their model into 2 pieces, climate and the rest, and use them separately with more emphasis on the climate part. And then there are some minor adjustments to be as compatible as possible with the EU Paris-aligned benchmark framework. They have some rules on how much you should invest into certain parts of the economy, etc. And we were almost compliant anyway, but now we have made sure we are fully compliant with that part of that rule set. Yeah, so that brings you to the total fund. And the active share now is 40%. So we're significantly different from the index, but we realize this difference in a tracking error minimizing manner. So the expected tracking error then is still 1%. This has shuffled around a bit on the overweights of the fund, and this is what it looked like on beforehand. It's the top 20 overweights, and that is one way of studying the portfolio. Look at which companies, do you have the largest overweight compared to MSCI World. And I've added some color indication there to separate the climate solution companies, these 10% allocation, from companies which have high green revenue according to FTSE, but which are not pure play, and then everything else in gray. So you have dark green, light green, and gray. And you can see that the biggest category used to be gray, everything else, so not climate related. So they are large just due to risk minimization or more random processes. So the biggest overweight used to be Nestle, and you have L'Oreal and Apple, Roche, Merck. So not companies which are related to climate. And this is a bit what I wanted to improve upon, to have a better connection between the largest overweights and the thematics of the fund. So half of the top 20 used to be everything else, 7 climate solutions and 3 high green revenue. And if we swap to after the changes then, now half of the biggest overweights are climate solution pure play companies, and another 5 are high green revenue companies, and only 1 out of 4 are not related to the thematic of the fund. So this just illustrates then how this change in the weighting regime, it's rather dry and boring, but it really makes an impact on the profile of the fund and what you see when you look at which companies have the highest stock specific risk. Because the higher overweight, the higher stock specific risk, and now we take more of the stock specific risk towards the companies that we thematically believe in. So that I think is a nice improvement. Next slide here. Just conscious of time, which is running fast. This is showing the FTSE Green revenue exposure of the fund. In total now we have 20% revenue exposure to green thematics versus 8 for MSCI World. And FTSE classifies it into different categories, which is shown in the histogram. And there you can see the red is the fund and the gray is benchmark. And for instance, from the left, energy equipment, that would be Vestas wind producing windmills. We are well above the benchmark. The next would be those companies which buy windmills and produce electricity. And then comes energy efficiency and so on. And consistently, we're quite well above the benchmark. And that's improved then. We used to be above due to the climate solutions allocation, but it's been improved further by the explicit tilt towards this data set. And this shows a bit more the improvement we made last year. On the left-hand side, you can see how this 8 and 19% exposure, respectively, for benchmark and fund splits into categories. If you sort the companies by their level of purity, how high is their green exposure from 0 to 100%. For red, you can see that most of our contribution comes from the right-hand side, which is the pure play. And for the benchmark in gray, then a lot sits to the left from the conglomerates. We are consistently above the benchmark, starting from the bin 20 to 30%. So from there and right, the red is well above the gray. And then on the right hand side, I've taken for the fund and split the fund's contribution into climate solutions portfolio, those 10% of pure plays, and blue, which is all else. And it's the blue part which is now significantly higher than it used to be due to this FTSE Green revenue data set. Because before this change, then the risk optimization saw that we force it to own 10% of pure play climate solutions. And the optimizer doesn't like that because it sees this increases my risk and I dislike risk. So what it tries to do then is to buy less of other similar exposure for the rest of the fund to compensate. So before this change, then the optimizer would actively stay clear of other non-pure play conglomerates which had some green revenue. So you watered out a bit of the effect of the pure play exposure by the risk management. And with this update, we prevent this from happening by telling the risk optimizer that you should seek investments not only in the pure play, but also in the conglomerates by increasing all of the green exposure. So this is a good improvement. Last improvement and last slide as well before the summary. What else did we do last year? I mentioned we did some minor modifications to improve the alignment with the EU Paris aligned benchmark rules, and we have more material on that in the appendix. It's a bit detailed, so we don't go through it here, but you can ask if you like afterwards for it. I mentioned already we use this science-based targets initiative data set to increase exposure to companies which have good third-party certified plans for being aligned with Paris Agreement in their operations. And in the table there, you can see how for MSCI World, the fund before changes and after changes, the percent of capital allocated to each category by science-based target status. No involvement means no relationship to these plans. 2/3 of the benchmark is there. And for the rest of the benchmark, some have committed, they are work in progress with making plans, and another 21% have plans in place with varying degree of ambition. And for the fund on the right then, after changes, you see on the lower line, it's instead of 21%, we have 1/3 of our fund is allocated to companies which has climate plans, certified climate plans in place, which are 2 degree or better. So we then have a preference, a soft but significant preference for investing in companies with good climate plans. And it can't be 100% because then the tracking error would be huge. So it's always this trade-off between tracking error and tilting towards climate. So to summarize, 2020 was a big stress test for any investment strategies, ours as well. But I'd say we passed that stress test quite well because when you look back at the year, the key takeaway is not what happened during March and April, but rather what happened during the rest of the year. To summarize, what happened was that we benefited on many points of our strategy, mainly by being fossil free in a year with poor oil performance, and having explicit exposure to climate solution providers, which benefited a lot from increased attention from politicians and also investors towards climate solutions. And we have continued our process of continuously improving upon our investment strategy as time goes along. And that I see as one of the main attractions also of our fund, in addition to long track record and good results, and hopefully what you see as a good implementation of how to address climate risk, is that you get a dynamic vehicle that we aim to stay state of the art by improving within the same vehicle. So you don't have to redo due diligence every year as things change in the market. So thanks a lot, and over to Alan.
Thank you, Henrik. We have actually gotten several questions, so if it's okay, we have budgeted 10 to 15 minutes to go through them. Just as a reminder, we will send out the presentation to everyone who's participating today, and we will also send out a link with the recording to this presentation so people can hear it again if they want to. But the first question we got is, ESG is more than just environmental. What about social and governance factors in the fund?
Yeah. So I mentioned that we use Sustainalytics as an input provider on the ESG rating side. And that's one part of it. Another is exclusions. Both of these address social and governance questions and also environmental concerns beyond climate. But let's first take the ESG rating part of it. I mentioned that we use Sustainalytics rating, but I split it into two, because climate is the main focus. So I want to be able to tune up the climate part of the ESG rating. But we also have use as a signal the rest of the ESG rating and improving on that. So for instance, when we compare ourselves to other funds in Morningstar database, they show the ESG rating for a broad range of fund. We see that our fund is very attractively positioned also in ESG in the broader sense due to this tilt. So that's the first way we improve ESG except climate properties. The second is via the screen definition for our fund. I mentioned in this waterfall chart that we have a fossil fuel tilt, but we also screen in place, but we also have followed the Storebrand standard, which is a screen we use for all investments across our company. And that covers exclusions based on breaches of international norms and conventions. And among them are then social questions, labor rights, human rights, and anti-corruption. So you also address other ESG questions via the screen side. And this fund also follows ISS red flags for international norms and conventions. And for instance, the largest exclusion of the fund currently is Tesla, which is a bit of a paradox because we really like it from the product side, but we are not so fond of it from how they make the product. And one of their things is to prevent their employees from joining labor unions. And they've been, a judge in California has has classified this as a breach against the labor rights in the US, and ISS have been in dialogue with them, and we have taken them as a consequence of this not succeeding out of the fund due to ISS judgment. So that's an example of how actually a social question has won over the environmental question, because we would like to fund the company otherwise, and it would have been part of the climate solutions portfolio. So, but it shows that we do have an eye to other questions than just climate, although the climate is the main motivation of the fund.
Thank you, Henrik. Another question is, the discussion of low carbon passive equity often focuses on the perceived need to find or create a low carbon index. What is the advantage of not doing this and benchmarking against just the MSCI, which is what Storebrand appear to do?
Yeah, no, so that's a choice you have to make. Do you benchmark against a strategy which has already implemented the climate view, or do you say that the climate view is a choice you make on top of the normal benchmark, and then you prefer to keep the normal benchmark? And we have a very strong preference for the last option, because what you do then is you keep visible the risk. If you manage your fund towards a benchmark which has implemented already climate views or ESG views, you can fully replicate it. So it seems like you have zero tracking error, but you have zero tracking error against a modified strategy, which is not the full world economy. And you then have maybe zero risk management of the risk consequences of your strategy. Whereas if we keep the full MSCI World as benchmark, then we can manage the risk that comes from our climate views and try to minimize the risk, because this is a fund for people who dislike tracking error. I mean, you should have a different view on climate, but you should dislike tracking error as such. And then I think it's nice to keep it visible and deal with it instead of defining it away by managing the fund towards a index which has a flavor, so to say. And I think at the end of the day, asset owners will always be measured ultimately against the full benchmark. That's like the ultimate target, that's the one benchmark that everybody can agree on and which has a very minimal set of assumptions. So whether you have FTSE or MSCI, they all agree what the market cap benchmark is, but they won't agree on what the climate benchmark is. That's full of subjective choices.
I guess we could add that we've been doing sustainability since 1995, and if we had used synthetic benchmarks throughout that period, we would have had several different benchmarks to look against. So by keeping towards the MSCI World, which is what our clients use, the majority of them anyway, we have...
Yeah, and it would have kept us back as well, because I think it's fair to say that we have been leading this development. So we would have then been more conservative behind of the curve if we would have been limited to the choices which were available as indices at each given point in time.
I'm aware of time here, Henrik. We have two more questions, but I'll take one of them here now. Only one current plant-based food stock. How do you see the future for plant-based food stocks for inclusion in the fund? Do you think the current meat-based food industry will win by focusing more on plant-based foods? Or do you think it's a better investment to invest in pure plant-based food companies with regards to climate change and the growth in the plant-based food market?
Yeah, thanks. So that's an interesting question. And you could say it's an analogy to the fossil fuel sector, where, for instance, Equinor are also going into windmills. So in the protein market, you have the old school meat producers also going into either cultivated meat. You can grow meat in the laboratory, or you can have plant-based substitutes. And in both fossil and in meat, you see this, that you have a mix between pure play startup more like companies and the old school companies going into it. And what we have been doing for our fund is to screen out the big pure play meat producers, just like we screen out fossil fuels. So that's part of the additional screen that we have, because we see them, they have too much assets value at risk, even though they also go in the direction of the new. I think it's the same with fossil fuel, that the old economy part, they are too entrenched in the old ways of doing it. They have invested too many assets into it, and they are maybe not agile enough in their way of operating. So I see the winners as the more standalone companies who are 100% aiming at the new stuff, really. And maybe they end up being bought up by the large meat producers in the end then at high multiples, but then we would be happy to sell because the price would be good. But as you correctly pointed out, there is only one such company currently in the fund, Beyond Meat. I'm not aware that there are many other listed companies. If anyone listening knows about them, then please make us aware of them. I must confess I've spent more time on the other parts of climate solutions. It's been a while since I revised the plant-based substitutes, so maybe it's time for a revision to see if there are any new IPOs in that space over the last year or so.
Finally, Henrik, if you can maybe give us 2 minutes to elaborate a bit more on what you mentioned, the EU Paris aligned benchmarks. Could you maybe say a couple of words on that with regards to your fund?
Yes, for sure. So there are many processes in the EU currently on sustainable investments. I mean, you have the regime for what should asset managers do in terms of marketing anti-greenwashing. Then you have taxonomy living its own parallel life, and the taxonomy is a bit analogous to this green revenue kind of thinking, mixed with do no significant harm principle. But then a parallel track has been the EU devising, making regulation for what do you need to fulfill to be able to label an index as this index is Paris aligned. So they have two layers of this, either Paris aligned or transition. And what they specify really detailed is really a climate motivated investment strategy. How much should you reduce carbon footprint? How much should you screen out of fossil fuels with which definitions, etc. So they're making like a mock-up of an investment strategy, which is motivated by the similar things as we have been motivated by when we made our strategy almost 5 years ago. So we come from the same side, but there are many ways of formulating this, and the EU there is a committee and they have agreed on a set of principles and one of the many different ways of doing it, but it turns out it's rather similar to what we have been doing over these years. And what we've done then is just to read up on it and try to, at least for the low-hanging fruits where we are really close to compliant, we have just made sure that we are fully compliant. And there is one point in their setup, which is a 7% year-over-year reduction in carbon intensity, which that's the one part we don't aim to be compliant with, because we already start out with so low emissions. We have overfulfilled, so to say, the upfront reduction in emissions. So if we would still keep the 7% starting from our lower starting point, that would be a bit strange. So to be compliant with that part, we would need to rebalance to increase our emission level to have a good starting point for doing reductions, but that would feel a bit bizarre. So we have instead said that we are already over-fulfilling that, and we don't aim to be compliant with that specific part of the rule set, but with the rest. Yeah. That being said, it's a framework for labeling indices, not funds. So we can't put the EU Paris aligned compliant on our fund anyway, because it's out of scope. It's only valid for indices.
Thank you. We have no further questions, so I think we can wrap up there. Just as a reminder, we will be having quarterly webinars on your fund. And what's quite fun actually to mention is that I guess next time you'll have a 5-year track record, which will make you quite unique, I think, in this space. Very few have the track record that you have, Henrik, and I can praise you. It's a bit easier for me to do so. Very successful track record also at that over this period. So we will be able to follow up on what you had to say today. But of course, in the meantime, I guess our clients and investors, there's quite a few on the line here today, can address any questions they have to their Storebrand and Skagen advisors. And of course, we can set up to answer any questions they have, or if they want to have a call with you at some point, Henrik, we can try to accommodate with that as well. And I guess, thank you very much.
Thanks for listening. Bye-bye.
Have a great day.